Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Jack in the Box stock is a buy. Jack in the Box, stock ticker symbol JSEK, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's dive into the world of a surprising stock market player, Jack in the Box. This fast food chain with the iconic popping clown isn't just about delicious tacos and curly fries. It's a publicly traded company with a rich history and a savvy strategy. Founded in 1951, Jack in the Box's story starts in San Diego, California, where founder Robert Peterson had a radical idea: a drive-through restaurant with a playful twist. Enter the mischievous Jack, popping out of a box to greet customers. Peterson's gamble paid off, and the chain quickly spread across the West Coast, becoming a pop culture phenomenon. Fast forward to today, and Jack in the Box is more than just a burger joint. With nearly 2,200 restaurants in 21 states, the company has expanded dramatically. But it's not a one-trick pony. Jack also owns Del Taco, a chain that specializes in American-style Mexican cuisine. Jack serves juicy burgers, crispy chicken sandwiches, and of course, those legendary curly fries. But Jack's menu also features healthier options like salads and wraps, catering to a wider range of palates. Jack in the Box still calls San Diego home and has over 70,000 employees across the country. Now let's look at the price action. Starting with the 1-year chart, we see that Jack in the Box had a CAGR of about 16%. Zooming out to the 5-year chart, we see that Jack in the Box had a CAGR of -1%. Jack in the Box share price has been a rapid climber recently. If we perform a backtest comparison of investing $10,000 in Jack in the Box versus the S&P 500, we do not find some strong results for Jack in the Box. In that comparison with the S&P 500, $10,000 invested in Jack in the Box would have shrunk to $8,218 or a -3% CAGR versus $18,848 or an 11% CAGR if invested in the S&P 500. This demonstrates subpar performance for Jack in the Box. However, a Jack in the Box investment would have been more volatile with a 50% standard deviation versus 18% for the S&P 500. Jack in the Box underperformed the S&P 500 in terms of the best year performance, for which Jack in the Box grew only 21% versus S&P 500 31%, and worst year performance where Jack in the Box fell 20% versus the S&P 500 18% fall. In terms of max drawdown, Jack in the Box fell an astonishing 63%, more than the max drawdown of 24% for the S&P 500. And surprisingly, Jack in the Box did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at Jack in the Box's market share. So we come over here and type in the ticker symbol for Jack in the Box and see that the market share is 0.19% out of the publicly traded food, beverage, and restaurant stocks currently in the market. This means that only 0.19% of all food or beverages spend goes to Jack in the Box. This is very small market share, but it is growing. The 5-year market share CAGR for Jack in the Box is 8%. This means that Jack in the Box is taking market share from other companies in the space. If we start in 2019, we see that the market share was 0.14%, 0.15% in 2020 and 2021, 0.17% in 2022, and 0.19% over the trailing 12 months. Though the market share at Jack in the Box is small, it has risen steadily over time and shows no sign of reversal. Let's take a look at the fundamentals. Gross margin is 30%. This is on par with expectations, and I would only expect for this to improve. Revenue has compounded at around 15% over the past 5 years and has reached over $1.7 billion most recently. Love the strong steady growth. Looking at cash flow, we see a 6% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 12% CAGR. As a result, free cash flow has grown at a 4% CAGR. Despite capex increasing as Jack in the Box continues to try to grow their footprint, I think the spend represents a good investment in the company's future. Weighted average shares outstanding have fallen tremendously over the last 5 years, going from 26 million shares in 2019 to 21 million shares most recently. Jack in the Box has been buying back shares pretty aggressively. This is what we want to see. In fact, almost 6% of shares are bought back and retired every year. Now let's view return on invested capital. Return on invested capital has fallen from 21.4% in 2019 to 6.2% in 2023. This is not good. Jack in the Box has become less efficient in driving profits from its investments. While these investments are clearly driving revenue growth, it seems that it has yet to trickle down to massive earnings growth. There is often a lag between investment and earnings growth, so I would expect this to improve, but we'll be watching it closely. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -11 days in 2019 to -3 days most recently, Jack in the Box has gotten less efficient over time. However, the worst cash conversion cycle value occurred in 2021 and has been improving since. I would not be surprised to see cash conversion cycle continue to fall. This also gives me hope that return on invested capital will start to improve soon. Now, let's look at Jack in the Box's debt. The net debt to EBITDA has increased over the past 5 years, going from 4.4 in 2019 to 5.2 most recently. This is the biggest red flag I have seen in analyzing this company. I would like to see this value less than 3. Last, let's explore dividends. Current dividend yield is a healthy 2.6% with a dividend payout percentage of 28%. Jack in the Box is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 13.6% dividend per share CAGR over the past 3 years and a 1.9% dividend per share CAGR over the past 5 years. Jack in the Box had previously dropped their dividend from $1.60 to $1.20 in 2020, but have raised it back up to $1.76 since 2022. The fundamentals of Jack in the Box are pretty decent. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Jack in the Box. It is a restaurant company with a gross margin of 30%. The 5-year revenue per share CAGR is 22% and the 5-year free cash flow per share CAGR is 10%. This is nice. Strong revenue and free cash flow growth coupled with a great gross margin. A return on invested capital of 6% is low, but I will be watching it closely for a return to growth. Next, the cash conversion cycle of -3 days is not bad, but still has some way to go to return to peak efficiency. Concerning debt, a net debt to EBITDA of 5.2 means that it would take Jack in the Box a little over 5 years of earnings to pay back their debt. So from a fundamental standpoint, Jack in the Box is okay. Now let's switch our attention over to valuation. Jack in the Box is undervalued relative to the S&P 500 with a ratio of 0.5. The price to earnings growth, or PEG ratio, is 1.9, indicating that Jack in the Box is overvalued relative to their projected earnings growth. Jack in the Box has had strong and steady growth over the past 5 years as noted by its market share expansion. Free cash flow has also grown and cash conversion cycle has been improving. In terms of fundamentals, the only tough area is the debt. It seems the debt in 2022 occurred to finance the acquisition of Del Taco for $575 million. What is really interesting is that Del Taco generated almost $125 million in revenue as the quarter before the acquisition, which means Jack in the Box bought Del Taco for about 1.1 times revenue. That is super cheap. Additionally, management has done a great job of allocating capital by slowly paying down cheap debt, aggressively buying back shares, and paying a steady dividend. Jack in the Box is doing very well and has a lot of growth potential. Given its product pricing levels, Jack in the Box looks well positioned to take advantage of the coming economic decline. In other words, the products are cheap enough that price-sensitive customers should be able to continue to buy, and wealthier consumers who are downgrading could add new customers. For these reasons, Jack in the Box is going on the watch list. Many thanks for watching. What do you think about Jack in the Box and their rapidly expanding market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.